check this out. This company beat their EPS estimation of $8.81 by a whopping $17, or almost a 200% beat on EPS. But the share price only went up 5%. Why is that? Well, let's dig in together. Heyo value investors, how are you doing? My name is Stijn and welcome to my YouTube channel. Today we're talking about Regeneron Pharmaceuticals, or ticker symbol REGN. I will try to keep this video as compact and concise as I possibly can. And if you appreciate that, show your support by liking the video and subscribing to the YouTube channel. Anyways, enough plugging, let's go into it. Let's start off with a company overview. So Regeneron Pharmaceuticals is, well, a pharmaceutical company. Regeneron currently produces and sells 8 different medicines, of which 7 are traditionally approved. And their 8th product is their COVID-19 treatment, which is authorized for emergency use only. And if we look at their latest 10K or annual report, we can see that they generate quite healthy amounts of revenue from each of the different medicines. However, they are quite reliant on Eylea and Dupixent. And this could be a huge risk if, for example, a more competitive medicine comes to the market. Also, from these yellow colored notes, we know that quite a bit of the revenue comes from collaborative agreements with other companies. In fact, if we look at this income statement, we can see that 30% from their revenue streams come from collaborative agreements. Just something to note. And aside from their current products, they have an extremely healthy and diversified pipeline of products awaiting FDA approval. In fact, 37 medicines in their phase 1 to phase 3 trials, of which 8 are in phase 3. So these are the most likely to hit the market anytime soon. And remember, just one of these medicines needs to hit big for Regeneron to increase the revenue with leaps and bounds. Just look at the example of regen-cov, which is doing amazing things for the company right now. And aside from their pipeline, Regeneron is actively investing in their technologies, for example their antibodies space. And this is of course to develop new technologies which they could leverage in the future. I would for sure recommend reading through the science tabs on their website. Very informative and very interesting, especially if you are considering investing in this company. And now I think it's time to look at some financials. This is a paid service that I use, the toolbox from Real One Investing. I use it to scan for stocks, but also to display their financials extremely easily and concisely. And the last is what we'll be doing in this video. The green color code for any financial metric is seen as extremely healthy. I want to zoom in on return on equity, or ROE, and return on invested capital, or ROIC. For both these metrics, we see a return of almost 20% as an average for the last 10 years. And they're actually getting a higher return on equity and a higher return on invested capital now than 10 years ago, which is just amazing to see. Besides, they have been growing their EPS at a very high pace for a long while now. So for the last 10 years, they average a return of 42.6% in EPS growth. And as time goes on, they only seem to be accelerating, which is just amazing to see. Also, their debt is displayed as 0.56 years. And this basically means that they could pay off all their debt in just half a year of earnings, which is extremely healthy to say the least. So for financials, this company gets a massive pass from me, to say the least. So now that we have a good picture of what Regeneron does and what their financial position is like, I think it's time to dig into their Q2 earnings. So to start off, they've managed to increase their revenue with a whopping 163% to $5.14 billion in revenue for the quarter. But of course, a huge chunk of these revenues are attributed to regen-cov. And I think this is mainly what is scaring other investors. The company seems quite reliant on their regen-cov medicine. However, the revenues excluding regen-cov still increased at 22% year over year. And their GAAP diluted EPS was $28 roughly, and their non-GAAP diluted EPS was roughly $26. So remember, non-GAAP is excluding one-time transactions. So in this case, GAAP is all the earnings a company received, so $28 per share. And non-GAAP diluted EPS is all the earnings a company receives minus the one-time transactions, so $26 for Regeneron in this case. So the consensus estimation for Regeneron for this quarter was $8.81. But as we now all know, Regeneron actually did $26 in EPS, which is a $17 beat. Just insane. And to put that insane number of $26 into perspective, that's way more than the company did in EPS for the full year of 2019. So to emphasize, they did more EPS in one quarter than for the full year of 2019. And aside from that, they released some very promising news for their current products, but also their pipeline of medicines. So I would for sure recommend reading through this yourself. To keep the video compact however, we'll continue with the next subject. And that of course leads me to the buy targets and price prediction part of this video. So from my last video to this one, I didn't change the first projection one bit. So basically what this Excel sheet is telling us that if they grow their EPS at 25% for the next 5 years and 15% after that, and if they combine that with a P ratio of 25 in the future, well, that results in a heavy buy target of roughly $580 per share. And that is of course including a healthy margin of safety of 50%. What that doesn't include however is the amazing year that is 2021. So this projection predicted an EPS of $38 per share for the full year 2021. But Regeneron already managed an EPS of $38 in the first 2 quarters of 2021. So obviously this projection is way too conservative with 2020 hindsight. So let's take this stellar year that is 2021 into account. Let's say Regeneron is able to do $65 in EPS for the full year 2021, which I think is attainable, and then we continue to grow this EPS at 15% for the next 10 years. We also slightly decrease the future P ratio to 20, and these numbers still gets us to a heavy buy target of $650 per share. And to be honest, I still think the second scenario is conservative. Seeing their insane financials, their healthy product lineup and even more healthy pipeline of products, well, I just can't help but be bullish on this company. I'm personally a buyer up to about $700 per share, after which the margin of safety decreases just a little bit too much for my comfort. However, we're nowhere close to that number right now. And I personally think we have plenty of time to build up a healthy position in this company. And I think that's about it. I really hope you guys enjoyed this video, and if you did, please give it a like and maybe even subscribe. Comment down below what you want me to talk about next, and I'll see you guys in the next one. Peace.